This is plummeting. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the political elite said this can't happen, and yet it is at one of the fastest pace on record. And that's what we're doing in Germany today, because when we look at what's going on in the manufacturing sector, not just in the Eurozone, but in Germany in particular, what we can see, it's gone from bad to worse. And if you think the U.S. manufacturing sector is exempt from this, then wait, we've got data on that too. But before we get to that, we've got payrolls to look at with today's non-farm payroll report. We know that Wall Street and all eyes are on this report, but is it as good as it looked? Well, we're going to show you why it's validating all the things that we've been saying, and that is the economy is indeed slowing down and heading to a recession. And if you missed yesterday's show, I did a big update on what's going on with my health. Many of you keep asking, why do I look like a vampire? And other things like, why does Steve eat cherry popsicles before he films every day? Well, answer to those popular questions and more, you can find them on my public personal Facebook page. You shouldn't need a Facebook account to access it, but go there, check it out, and you'll know everything, along with what we got for today's show with a headline: U.S. payrolls rise by more than forecast while wage growth cools. Now, we've been making this case that wage growth is slowing. We've been talking about total compensation. This is total weekly hours multiplied by average hourly earnings, and we've been seeing it decelerate. And the case is really simple. You hear from these political elites like the Fed chair, politicians, well, hey, it's just an issue that companies need to give bigger raises. And we're making the cases, unless prices keep rising and they're decelerating, companies don't have the ability to do that. They can't pass on higher wages without taking it out of their margin. We know they don't do that. And so in turn, as wage growth slows, what we should see, and we made the case in yesterday's show, is that we should see payroll growth slow as well. And we did. Non-farm payrolls rose by 187,000 after the two prior months were revised significantly lower. And that's not a good sign. When you see this downward revisions, now in an up market, when we're seeing, not just I'm referring to a stock market, but I'm referring to an economic market that's getting better, what you want to see is prior reports be revised higher. Now what we're seeing as things slow, prior reports being revised lower, putting at the question here is maybe today's report isn't quite as good as the headline suggests, but we won't know for sure until next month or the month after. And here we can see the unemployment rate, which everyone's been fixating on, climbed, so it went higher to 3.8%, the highest since early last year, and largely reflecting a pickup in participation. Now, we'll talk about participation here in a little bit, but that's the percentage of age-eligible people who are participating in the workforce. But I want to come back to, of course, this unemployment rate, because there's this headline number that you hear. Well, there's another number called the U6, which you don't hear much of. And yet the U6 went from 6.7% to 7.1%. That's a pretty big increase, while just the regular unemployment rate finally moved higher to 3.8%. And what we can note is, of course, our Fed chief, Jerome Powell, said he wants to see the unemployment rate go higher. He wants to see people lose their jobs because he needs demand to come down. He needs that wage growth to slow because he believes higher wages are going to drive higher prices. When we're making the case, there's higher prices that lead to higher wages. Nevertheless, what he wants, again, is more people on the unemployment line. But what he's missing here, perhaps, is the U6 is looking like it's about ready to move a whole lot higher. The question is, what is the U6 and why does it matter? Well, if we look at the U3, it's the unemployment rate that's most commonly reported rate in the United States, this according to Investopedia, representing the number of unemployed people actively seeking a job. The U6 covers discouraged, underemployed, and unemployed workers in the country, giving us a much better look here. And that seems to be true because economists view the U6 rate as more meaningful because it covers a larger percentage of people who are unemployed. Not to mention, you could have someone who wants a full-time job, can't get one, so they take a part-time job. In the regular U3 report, the headline report, well, they're employed. But in the U6, it says, well, wait a minute, they're underemployed. So where the U6 is going, it it tells us where the U3 is likely to follow. And sure enough, on this next slide, that absolutely validates it. Now, just so you're aware, I have them kind of adjusted on each side of the chart. So over here, it looks like that the U6 shown in blue is actually lagging the U3. It's actually just the opposite. What we see is, of course, the percentages on the right side are lower than that on the left side. So the U6 here in blue driving faster and accelerating up into recession. You see it here in the global financial crisis. It kind of breaks trend and accelerates up. And right now, we kind of see that at 7.1 versus 3.8. We're starting to see the move that the U6 is headed higher, validating that indeed the economy is slowing down. And that's why, of course, we saw the payroll growth number actually slow down again. And it's all about the trend in the non-farm payroll report, because we know based on past cycles, it can show a positive payroll report even in the middle of a recession. It's not usually till the mid or late part of the recession that it tends to go negative. Not all the time, but let's keep digging. As the labor market has been the stalwart of the U.S. economy this year, supporting renewed momentum that may help the nation avert a recession. At least that's been the hope, and in the near term. While job openings and wage gains have both retreated in recent months, as we said they likely would, hiring and incomes are still firm enough to bolster consumer spending, at least for now. And that may be the bigger issue here, because we know there are some things that are headwinds that are coming. We know the student loan repayments are coming back. We know the credit card minimum payments are going up. We know that savings rates have been plummeting, and then people are tapped out of that. We know that credit cards should be near their maxed out level, and banks aren't looking to extend more credit. So there's a lot of signs here that say these wage gains just aren't enough, but we'll look at that a little bit deeper. That said, Friday's report offered fresh signs that hiring hasn't been as strong as previously reported. June and July payroll gains were revised lower by 110,000, which is quite a bit, following data last week that estimated job growth was probably less robust in the year through March. The report showed more people are coming back into the labor force. Now, I want you to think about why this happens. Why do people come back into the labor force? Well, they need money. It makes perfect sense. Which may also help soften wage pressures. Of course, it does. The more people that are signing up to get a job, the less an employer has to pay. The overall participation rate, the share of population that is working or looking for work, rose for the first time since March to 62.8%, the highest since February 2020. And for those ages 25 to 54, known as a prime age group, it approached a record. And here you can see the labor force participation rate in blue against the consumer price index. Now, why are we looking at this against the CPI? It's real simple, because when inflation gets too hot and wages don't keep up, or we see weakness in the job market, that pushes people who are out of the job market back into it, because again, we're making the case that they need money. And that's what we're seeing here. All of a sudden, the trends are starting to change, not in exactly the way the Fed wants. It's telling us people are just running out of cash. And we see the labor force participation rate again in blue against the consumer price index. And you can see as the CPI rolls higher, well, more and more people enter the workforce. You see that trend here in the mid 90s as well. You can see it again into the 2000s, going in the dot-com bubble. We see it around mid 2005 as the CPI went up. More people started looking for work, again, going into the global financial crisis, heading into the pandemic. And wow, look at this right now. You can see as inflation took up, despite the fact that people had tons of money, according to the government, and we're sitting on mountains of pandemic cash. Sure enough, what we see are more and more people headed back into the labor market, but may not be finding a job. And with the supply and demand for labor coming more into balance, the outsized pay gains during the pandemic, well, they faded, and we've certainly made that case. Average hourly earnings were up only 0.2% from July, the smallest increase since early last year, and 4.3% from a year earlier. So we made the case, and we're going to look at these charts again, that we're seeing a kind of a slowdown in wage growth. We know that that is going to be balanced off also by the fact that participation rate is rising. More people looking for that job. Well, that means less money that employers have to dole out. But one thing that should not be seeing the smallest increase, well, that's your trading account. Let's take a look at our recent call the report had on platinum. And what we can see here is our initial trade that did not work out. And here's our second recovery trade we've been talking about on the Sunday YouTube show. And for those who missed the first one but jumped on this one, this is now up a little over 4%. And what we can see is between the two trades, not only did we dollar cost average and are ahead, but we got that recovery trade right where we want it. And I will talk about on Sunday, I still think the move for platinum could be higher, making this a nice 4% return in about a 2-week period. And here you can see on July 13th, the initial signal, the buy-in signal, that one didn't quite work out. Here you can see on August 23rd, the second signal, giving our subscribers that indicator that, hey, it's time to buy. And then twice a week on Wednesdays and Saturdays, not only do we go through and publish the reports as we do, but we also give them a list of things that we see to keep an eye on that are really down and looking to reverse, because all we're doing is looking at the machine positioning, running a second historical overlay, and showing you where the biggest opportunities there are at, giving people, our subscribers, huge confidence when it comes to their trading. And when it comes to confidence, well, the Fed's got a lot of that in the non-farm payroll report, and for reasons we don't know, because what I show on this chart, now I had to cut off everything going from the pandemic on, but I wanted you to just see if we see a deceleration. And you'll notice that each deceleration leads to this thing called a gray bar on the chart, and that gray bar, well, that means a recession. And so we're seeing that deceleration now. We're seeing that downtrend in revisions on prior reports, all validating we are indeed headed toward a recession. But let's talk about total compensation. We have average weekly hours multiplied by average hourly earnings. This is a production and non-supervisory employees. And sure enough, what we see as all employees, now we have the total non-farm shown on a year-over-year rate of change. So what we can note is as employers start to decelerate their payroll growth and even contract it at some point when it's below the horizontal black line, as payroll growth slows, well, what happens is so does total compensation. They start giving out smaller and smaller wage increases, less hours worked, and it all starts to slow down together. And so we've been making the case that total compensation is likely headed down. Well, based on today's payroll report, that's certainly something we should expect in the months to come. And of course, it's validated all of this by the fact that employers are not getting the big price increases they were before, as employers were demanding it, because they said, hey, wait a minute, you're charging a lot more for these products and services. We want a piece of the pie. Well, now all of a sudden, with the consumer price index decelerating and coming down, it tells us that total compensation is going down with it. You can see this wonderful relationship between the two, because despite the fact that we hear from these political elites that they seem like there's an unlimited pot of money by corporations and employers to raise wages, the reality is there isn't, unless, of course, prices go up. Well, employers can't raise wages too much because they just don't have the margin. And what we learned in the past is when profit margins start to get too thin, well, employers will lay off anyways, so it doesn't really matter here. What matters is the likeliness that we're headed into recession, because not only consumer prices are headed down and payroll growth is headed down, but total compensation continues to fall. And at some point, all of them are going to nosedive pretty quick when we take a look at what's going on in Europe and apply that to what's coming to America. The labor market will continue to be key to the economy's trajectory, but other factors could thwart its momentum. Of course, we know what that is called the inverted yield curve. And high prices are still pinching consumers, and the upcoming resumption of student loan payments will be a renewed burden for millions of borrowers and will chew up a lot of discretionary spending. And yet some economists have recently even questioned the accuracy of the labor data due to lower response rates. The response rates for the establishment survey, which produces payrolls and wage data, get this, was the lowest for any August since 2006, telling us what we already know is coming in the next 2 months, likely downward revisions. Some reason employers don't want to report to this, to the Bureau of Labor Statistics, to us. That is a huge red flag. Let me know what you think in the comments. Do you think this is just a minor issue? They were too busy handling new orders to send in their reports? Or do you think perhaps they don't want everyone to know that things there are getting worse? And talking about getting worse, now let's head over to the Eurozone. As prices for Eurozone goods fall further, this from the S&P Global Eurozone Manufacturing PMI, or Purchasing Managers Index. Goods fall further in August as factory orders, get this, continue to plummet at one of the fastest rates on record. Here you can see Eurozone Manufacturing PMI 43.5, now solidly in recession territory. That is any print under 45. Here we see new orders at 39, also in recession territory. Let's take a look. According to the August data, the volume of new orders received by manufacturers across the Eurozone continued to plummet at a rate which has rarely been exceeded across the survey's 26-year history. Wow, that is staggering. This too was the case for new export business, with firms struggling to attract new work from clients beyond their own borders. And it doesn't end there. Eurozone manufacturers also recorded a considerable decline in their backlogs of work during August. Now, why do backlogs matter? Because when you don't have a whole lot of new orders, you take your workers and say, hey, you know what? We've got all these backlogs, these, not priority orders, these things that could be done later. Let's do them now. And what happens when you have a lack of new orders and you've chewed through all your backlog? Well, what goes next? Well, those are your employees. Extending the current sequence of depletion to 15 months is signaling a sustained rise in spare capacity. Reduced workload volumes subsequently led manufacturing production to fall during the latest survey period, as has been the case since the middle of last year. And meanwhile, factory employment levels, which are coming down at some point, but look at this, across the Euro area fell for a third consecutive month in August, while the rate of job cutting was only marginal. Again, we're making the case that will change. The sustained decline in staff numbers represented a marked turnaround from the general trend seen between early 2021 and the first half of this year, where we just couldn't get enough employees. And what we're seeing is, just like in the economy, when after the pandemic went from this boom and is now bust, we're going to see the same in the labor market. There was a boom in big demand, and that demand is going to go away along with inflation. And that's what's baffling about headlines like this is Eurozone inflation comes in higher than expected in August, and we'll say not for long, because when new orders go down, now we don't have, of course, the data in the FRED database from Europe, but we can use the U.S. data, and we know when new orders go down, this from the Philly Fed Diffusion Index, and we've overlaid the Consumer Price Index, that when the trend of new orders is going down with a lag, of course, that means the Consumer Price Index goes down, because as demand goes down, prices go down, or the growth slows and then maybe eventually contracts. We see that trend over and over again, suggesting that this notion that we're going to see high rates of inflation, well, as long as the factories aren't humming at big rates with demand, what we know is inflation is indeed slowing and has a risk at some point of going negative into deflation. But now we're in Germany here checking out the automobile sector, because look at this. The German manufacturing sector remains mired in contraction territory midway through the third quarter. Notice how they didn't print those numbers? Well, let's go find them. And here we can see the gauge of overall business conditions based on measures of new orders, output, employment, supplier delivery time, and stocks of purchases came in at a depression era print of 39. That means under 40 now. There's a 3 in front. That is bad news. And as just slightly better than last month's 38.9. And this was almost, of course, a big problem as manufacturers scaled back output for the 4th consecutive month in August. Furthermore, the rate of contraction accelerated once again to the fastest seen since the initial COVID shutdowns in the spring of 2020. Could you imagine that we go from a pandemic slowdown, right, that crash in the manufacturing sector, to one of the biggest booms the other direction, and then a second crash when there's no pandemic going on? Could you imagine what that's going to look like to these politicians and these policymakers? It's going to be wild. In factory employment fell fractionally midway through the third quarter, having posted the first decline for 2.5 years in July. The survey suggested firms were reluctant to make large-scale reductions in staffing capacity, but they will at some point, with incidences of lower employment often attributed to the non-replacement of leavers. And now let's take a look at the U.S. A sharp contraction in U.S. manufacturing, or sharper contraction of that in August. As we dig deeper, the PMI fell to 47.9, so we know indeed the U.S. manufacturing sector continues to slow and is in contraction from 49.0 in July, indicating a stronger downturn in the operating conditions at U.S. goods producers. The manufacturing sector has contracted every month since November 2022, except for a brief stabilization in April. The overall deterioration in business conditions was driven by a further decline in new orders. No surprise, where new orders go, the headline follows. Lower new orders were blamed on a weakening economy and customers being cautious in placing new contracts. The rates of decline accelerated since July to register the second steepest reduction seen over the past 6 months, if you can imagine that. And the latest reduction in new orders led firms to further reduce their levels of work in hand, with backlogs, here we go, declining for the 11th month running, the second longest sequence in survey history, suggesting that once those backlogs are gone, well, we know who's going next, and that is the employees. Let's look at this last bit from the report. An increasing sense of gloom about the near-term outlook has meanwhile hit hiring and led to a further major pullback in purchasing activity. So what we're seeing here is indeed a full feedback loop starting to form, where a lack of new orders and demand goes down, the backlogs get chewed up. That's going to lead to a decline in employment. That's going to lead to a lack of demand. And then you're going to see this thing spiral out of control until, of course, the policymakers do something. And we know what that is. It's called the Fed. Back at zero. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.